What I would look at, I think, over the years of how this has changed, number one, is if it's looking at the property management company. So, who's the proposed property management company on this deal? What's their experience in this area? Obviously, like you said, if I'm working and we're not going to lead it. We're going to be a co-GP on this deal, and we're not going to be boots on the ground. Um, how long have they been in that area? And then the second thing is when we're getting into the actual property, I really want to see current rents where it is. I really spend time on location and then the current rents and then also what they're comparing their rents to.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is your host Ted Patel, and welcome to this week's edition of Decoding Cashflow Podcast. Today, I'm here with Charles Carillo, who is a managing partner at Harborside Partners, a real estate syndication firm. Charles has been actively investing in multifamily and commercial real estate since 2006 and has built a wealth of experience in acquiring, managing, and scaling investment properties. He's also the host of Global Investor Podcast, where he interviews industry professionals about investing in U.S. real estate. So I'm excited to dive into his journey, insights, and strategy. So let's get started. Charles, welcome to Decoding Cashflow.
Thank you so much for having me here, Ted. It's great to be here.
All right. All right. So, Charles, before we get into the details of what you do, right? If you can give our listeners a little bit background about yourself, what did you do before you get started into real estate, and how did you get into real estate?
Yeah, so I grew up in like a multifamily. My dad was a multifamily investor since 1984. So a few months after I was born, he bought his first multifamily property, which was a 6 unit. And let's be nice and say it was a C- property, but it was really like a D plus property. And he started buying properties in those areas for many years, and that was kind of like my second education. He self-managed them. He had a small team and of people that really did everything. Superintendents, handyman, the whole nine yards, and he and a partner got it to like maybe like 100 units in the 90s before they started selling it off. But it was because it was very intensive, time intensive. It's a very tough asset class of properties in multifamily. But I learned a ton about the business and about you know he really told me to buy in better areas, and that was advice that he took later on in his life as well, and changed around how he was buying properties for his small little personal portfolio that he built afterwards after selling off all those properties. But when I started buying property in 2006, I started with a house hack, and it was a great experience because it allowed me to not only purchase a property but also I rented out one floor. It was a three-family house. I lived in one floor. I rented out two floors, and it was fantastic. It was a great way of becoming kind of dipping my toe in and being a landlord myself. And then I bought another property a couple of years later in '08, and then I bought my first commercial property at the end of '09. I think it was. It was a small like mixed use multifamily with one commercial unit, which I use as my office. But yeah, that was kind of like how I got started in investing in multifamily and real estate in general. I flipped some houses around them, but I didn't really like it as much. It's very time consuming. It's difficult to consistently find. That's the problem I found with like contractors and the whole nine yards. So I stuck to what I really liked, which was doing multifamily, renovating them, updating them, whatever had to be done. I bought some that needed major renovations. I bought some that just needed like a little bit, and got them up and running. And I bought them all really within like a half mile of each other, so it was very easy for me to manage. I managed them myself for 6 years, and then I brought in a full-time third-party manager in 2012. And as I moved to Connecticut, I moved from Connecticut to Florida, and since really 2018 down here in Florida, we've really been focused on syndicating properties, multifamily properties throughout Florida, mainly Georgia, and in Dallas Fort Worth area as well of Texas. So that's kind of what we do now. And for the last several years, we've been really focusing on our multifamily business and syndicating properties, and as well as building kind of joint venture deals and stuff on the side with partners myself.
Yeah. So, all right, love it. So you had a background, right? Your dad did the multifamily. He was already in real estate. So while you grew up, you had a feeling of how the real estate operates, how to maintain, what are the pros and cons, etc. So that gave you leverage over others who didn't have that background to support the career, right? So did you start with real estate from the beginning of your career, or did you do something else before you get into the investment side?
I started a small business, a small payment processing company that my brother now runs in college, and it
Mm,
was that was kind of like how I put together funds for investing in real estate myself. So
mhm.
that's how I did it. Because obviously, real estate's a pretty capital intensive business. So it's you got to have some sort of funds going into it, getting approved for loans, all that kind of stuff. So that's what I had done initially, and then kind of switched gears, going more full time into real estate. Really when we start syndicating properties, like 2018, 2019, like that made the switch over, and my brother took over running that. And it's been quite the journey. I mean, it's great. I've been a full-time entrepreneur. I never had a W-2, a true, W-2 after college. And then just kind of a few months after graduating college in '06, kind of purchased my first property and kind of started the whole process there and learned a lot of things I did wrong. And then on my second property, I think I really got the aha on my second property of like how this all works, because the first one was kind of like a little bit of a mess, you know what I mean? And the second one though, you're like, oh, okay, this is like I did it much better. I wouldn't say right, but I did it much better this time. And I was like, this is how it works. This is how it's supposed
Yeah.
to
So
operate.
now
So
I'm getting all the cash flow. Now I'm able to take the tax advantages, do the
yeah,
write-offs, depreciation, everything. So yeah.
yeah,
So it's just a
uh,
little by little. Once you get a hang of it, then you don't stop looking back.
yeah, exactly.
All right. So you mentioned you started syndication in 2018. Tell us about your first syndication project. What was it about? And.
So I got involved in syndications doing a passive investment at the end of 2018, and then we did our first active one in 2019, and it was I think it was 59 units in Tampa. I was living in St. Pete, so right next to that for about 4 years during this project, but it was um, it was something that was probably built there was kind of it was a portfolio of properties. We had like a 32 unit, and then we bought 27 units around it, so it was two different kind of purchases,
Okay.
which was very difficult to buy a portfolio like that from different sellers.
So they were all separate properties, or there were two separate properties or multiple separate properties. How many?
Yeah, it was two purchases, but what happened
Okay.
was there was a 32 unit with an
Okay.
office, which was kind of like pretty much right in the middle. And then we had around it, we had bought all quads and threeplexes that were from
Okay.
another person. So we used the same office as for all the properties. We were trying to
Mhm.
buy another 22 from a different seller as well, but that didn't go through. They backed out, but it was because our goal was to get 81 units in that area, and it would have a little bit more scale. So it was fine. We did well in that deal. We bought it 1 year before, yeah, just under a year before COVID started, really. But it was it was definitely a project, C-class project. It was some of the buildings were built in the late '60s, some were built in the '70s, which really isn't something that scared me because when I bought in Connecticut, those were like 100-plus-year-old properties, right? So I was kind of used to older properties, and in Florida, they call older properties built in the '60s and '70s compared to, in other parts of the country where we
Northeast,
might
which
say,
is like in 1900s, right?
yeah, we'll call old like
Yeah.
1904, not
Yeah.
1964. So
Yeah.
the thing is that with that being said, it was just it was an experience going through the properties and first time raising money from investors. I'd never had to do it before, and so it's not only you add on a whole new element to the business. You know what I mean? You're not just buying property and figuring out getting a good deal and underwriting it and getting contractors lined up and inspections and all of this. Now you're also managing the whole other side of this project, which is your investors, which is a whole different ball game. You know what I mean? Which I
Yeah.
wasn't aware of before. Being on the other side, of that as a passive investor for a deal, I had an idea of how it worked. And yeah, we put together a small team. We did it and raised 1.8 million, I believe. And yeah, we closed the property, and I think we sold it 2022. Yeah, I think we sold 2020, beginning of, yeah, 2022. I think we sold the beginning of 2022, we sold the property, and the other half of it, we sold it like midway through 2022. So that's
Mhm.
about a 3-year hold on that, which we were expecting it to longer, but obviously the market went really crazy, and we were lucky to get out of that before stuff started cooling down with higher interest rates. But yeah, it was definitely it was definitely an exciting experience, and it was a great learning experience for it. And for all of our investors that came along with it, I mean, we did well on that deal. So,
Mhm. Right. And how did he source this property? Like, oh, did it come through a dealer or it was direct marketing? What was the strategy used?
one of my partners had sourced it through. It was on market, and they
Mhm.
sourced it through it was owned by international investors, and that sold us part of their portfolio, but didn't sell us the rest of the portfolio. And the area was right on the cusp of like gentrification. So it was like you drive through and you saw, you know, some properties that had work done that looked nice, and then others that were like, wow, like this is next in line. And then as you drive through it, it's consistently one of those areas throughout our ownership of that. You couldn't go more than a couple blocks without seeing a dumpster. You know what I mean?
Mhm.
Construction dumpster, in the sense of like there was just, and that's kind of one of the things you shoot for when you're buying real estate that's going to appreciate. I mean, it's like you're seeing people put money into the area, they believe in the area, and yeah, it was you put all those things together, and you're able to buy a good deal. And we managed it correctly. We had a third party property management company
Mhm.
that was very well versed in the area, which was really important. And yeah, that's kind of how we put everything together there. And we financed it all with I think it was like Fannie Mae loans. So it was all
Okay.
Fannie Mae that we did it on, and that was it definitely was a trying experience for some of the properties.
Mhm.
But we went through, we were off on one of, there was like maybe we thought we were going to do like 8 roofs, I think it was. It was an extra roof we had to do, so we had to put money out of reserves into it and stuff like that. But these are things you just learn. You know what I mean? Our numbers were
Yeah.
pretty close, but obviously, it's your first time through, and as much due diligence as you do on a property, there's always something you're going to miss, and that's an important
Yeah.
factor. And you make up for that by adding on to your budget, but also by having a reserve fund. The reserve fund is what makes it. You know what I mean? Because that
Yeah.
allows you to weather the storms, especially if you're getting financing from you're getting draws from your lender. You know what I mean? Which obviously in construction, but even in larger renovation projects, you're getting draws from they're not just coming down there the day you pay your
Yeah.
contractor and cutting you a check. You know what I mean? So it's a
Yeah.
whole thing of you have to have that float between. And these are a lot of things, because it's the first time in a project that I hadn't put funds together myself to take care of the renovation. So this was a different learning experience for that, and it works well. I mean, everything kind of ends up well, but you have it's a quite the learning experience of what you're doing when you're in a larger scale, working with a government entity, ESE kind of lender.
Yeah. And I do, I'm on the same page with you. You need to have the funds because, as I told you earlier, we are into the ground up construction business, so where we have to draw the funds at every single steps. So you have to have that buffer in between, so that you don't wait for the fund to come in before you move on to the next step.
Yeah, exactly. And it's something that it's just we I mean, it's just something that people don't put two and two together. I think when new investors are looking, and I made this mistake too. I think every investor has, that starting off, is that when they talk about the funds ready to close, they're talking about a down payment. I'm buying $1 million property, I need $200,000 or whatever, 250,000. They don't talk about all the closing costs they go with it. They don't talk about the renovation budgets that are required. They don't care about the reserve. And that
Mhm.
250 could change quickly into $400,000. You know what I mean?
That's
That you
true.
really should have. And if you start cutting corners or thinking you're going to fund it out of cash flow, you're in for you're in for a tough ride, my friend, because that's just
That's
not
true.
something that happened.
Yeah. And at the initial stage, you can't rely on cash flow, right? Because it's not much predictable at the initial stage. Once you have done renovation, add-ins,
Yeah.
cut down the cost, and then you can see some additional cash flow flowing in. But on the
Right.
very first day, few months, uh, you can't rely on the cash flow for sure.
Exactly. Yeah.
Yeah. So the other thing is like as you said, you have been in syndication since 2018, right? So what what are your main criterias or strategies, to decide which sponsors or deals or market to focus on?
Yeah, that's a great question. So, kind of how our business is put together is that we work in three different areas currently. That's where we have properties, and our goal for going into a new market is working with an experienced sponsor and that has boots on the ground in that market. So, obviously, I'm not boots on the ground. I live in Southeast Florida. I'm not being boots on the ground in Dallas or in our deal outside of Atlanta, stuff like that. We're working with groups that are managing those deals with boots on the ground that understand that have the contacts. So the main thing is, other than being boots on the ground, it's also having the contacts and having kind of the Rolodex, let's say, of people you're going to work with. And that's including all of your contractors, that's including the property manager, because I don't want to go into a deal being whether I'm partnering as an active investor or whether I'm going in as a limited partner and a passive investor. I don't want to be coming along and being the first deal with a new group in the sense of like a new team that they've put in place. So
Yeah.
hey, we've done really good in Atlanta, but now we're going to Jacksonville and we're going to be down here and it's all new. Well, that doesn't really give me that at that point we're not there's not anything that's super special about that because anybody can go and do that. It's different if you're I one group you're investing with and it was like for a deal in Dallas and it was I think it was like 13th deal they've done, which is in like a
Mhm.
45-minute or hour drive. I mean, so you're talking about thousands of units. I mean, they self-manage the property as well. The knowledge that they had, that's why it's done well. It's something because you're just getting you're something that's already been done is now
Mhm.
just being duplicated. It could be a sixth, a tenth, a 15th time,
Yeah, it's all
and
rinse and repeat for them.
right. That's what
Yeah.
you want to hear, and that's what you want to hear that they're using the same people. That means I don't have to. There like a lot of things that if there's an issue with your property manager, you can just change it. Well, anybody that's changed a property manager before, it's extremely difficult. No matter if you have 10 units, I've done it with a small portfolio of, a couple dozen properties to done it with hundreds of units. It's extremely difficult. It's very time consuming. And it will take it takes like literally a year to really fully move over from everything being changed around to everything working correctly how you want it to when you're doing that. That
Mhm.
takes the eye off the ball of that general partner from changing property manager to, hey, how do we what are we going to do here to get rents up in the sense of like how can we change our marketing? How can we get more inquiries coming in? How can we get these units turned faster? That's where people and asset managers should be really focusing on. That should be where they are, not on we have to switch a basic service, which is property management. That should be something that's already set. Because there's so many different things that you have to take care of, especially during a value add process. You don't want to be kind of swayed to one side or the other where you're working, kind of keep on keeping your property manager going. You want them already running and you want to be dealing with, hey, we're going to have three different units that are going to come up vacant. Make sure the contractors that are there take care of this. We have these common area projects like the roof and stuff. We're going to get these done. That's where you want to be spending your time as asset manager, not trying to look over the shoulder of your property manager, making sure that they're doing what you're supposed to do. You know what I mean? And that's kind of
Yeah.
something, you want to make sure they're doing what they're doing, but you also don't want to be in there micromanaging their day to day.
They need to be they need to have time to implement the strategies, right? That's what it is. Instead of just doing the regular day-to-day job, how can you increase the cash flow? How can you
Mhm.
decrease the
Yeah.
expenses? What are the other areas where you can add some additional income, etc.?
True, true.
Yeah,
Yeah. And
yeah,
yeah, there's a lot of moving parts with that in regards to property manager just is it's a thankless job. And if it's done well, I mean they're behind the scenes. So it's a very difficult job.
yeah. So now, when you get a deal from the investor, right, to take a look at it, or operator, I would say, not investor. when you get a deal from, what are the things that you look at into that deal?
Mm.
Not only at the operator level, like the experience of the operator, how many cycles they've gone through, but that's of course, you take into consideration. But while underwriting that deal, just to make sure the numbers make sense, what are the steps that you will take?
Yeah, that's a very good question. So when I was saying before about the different areas and markets that we were working on with having a team there, if they're in our backyard here in Florida, it's something that we know we're going to be more active on the ground with, and we'll be taking more of those roles. But one of the first things, whether you're looking at a deal if I'm a passive investor or whether I'm an active investor, I think myself, what I've done, and myself not being an underwriter, but what we'll do is we have an underwriter in house, and then we also use a third party underwriter as well that's not connected, let's say, to our company, right? Doesn't have any kind of upside if we take a deal or not. And then you kind of put together those notes between what you find as myself being I guess, more of an amateur underwriter. But what I would look at, I think, over the years of how this has changed, number one, is if it's looking at the property management company. So, who's the proposed property management company on this deal? What's their experience in this area? Obviously, like you said, if I'm working and we're not going to lead it, we're going to be a co GP on this deal, and we're not going to be boots on the ground. Um, how long have they been in that area? And then the second thing is when we're getting into the actual property, I really want to see current rents where it is. I really spend time on location and then the current rents and then also what they're comparing their rents to. So as value add operators, what that means is we're going to a property, we're finding a property that hasn't been updated in an area in a certain amount of time, usually 1 or 2 decades. And we're going into that property, we're going to see that if it's upgraded, we know that we're going to be able to increase rents 20, 25%. And this doesn't mean that we're just going to be going in there and not upgrading units and adding 20, 25% to people's rents. It means that as units turn over, what we're going to do is we're going to renovate those units and we're going to re-rent them out. And obviously, as we're doing work to the property, we're going to increase rents a little bit more for people that are currently there in the legacy units. But that's something that I've really spent a lot of time on. And as my first thing is really on the area itself, and then also on where the rents are and where they tell me they're going to go, and what those comparable rents, where those locations are for them. So if someone tells me, I mean, someone I remember like 3 years ago brought me a property and the comparables were 3 miles away. Like it means nothing. It's something if it's like it's a block away, you know what I mean? Because everybody's driven and seen something
Yeah.
3 blocks away, and you're like, oh my God, what just happened here? You know what I mean? This has changed. Like, you want to make sure, and if you're not driving it physically, I mean, it's something that you want to be able to, when you're searching on maps, be able to see exactly pinpoint where they are, and then also seeing, what is the difference between those two properties? Because these
Yeah.
are things you can't change. You know what I mean? If you're saying that, okay, they're both built in 1988 and they both have similar 100 units and they've got a pool and they've got this, well, that's great. But the thing that was that what we left out was that it's a half mile away, there's a highway between it, or there's train tracks between it, or there is a body of water, whatever it might be, that's going to really separate that area that you really don't know that well unless it's some things like, well, there's a Starbucks right here,
Yeah.
which we love, and our property's a half mile away. But between it, a lot changes. And that's going to be something where if we're buying a property and, properties, neighborhoods take time to gentrify if that's what your plan is. And it's different if you're saying 10 years, but if we're working with investors, it's a 3 to 5 year plan is what our goal is. So you have to make sure that you're not starting that wave. You're really just kind of riding the wave as it's actually moving. And yes, you'll pay a little bit more than the person that's going to own for 15 years. You know what I mean? But the thing though is that's kind of our goal is seeing something that's already moving and making sure it's going in the right direction, and we can place ourselves kind of within that.
No, absolutely right. The neighborhood changes like every mile. I would say the neighborhood changes, right? As
Oh,
you
yeah.
mentioned, there's a lot of ease to connectivity that might change. The business in that area, maybe the new hospital in the
Yep.
area, that might drastically change the rents for one property versus the other, which is 1 mile away.
Right. Exactly.
Yeah. Right. So now, with regards to decreasing the expenses and increase the NOIs? What any specific strategies that you have in mind that you like to tell to our listeners?
When we've come into a deal and you're usually successfully able to decrease some of the expenses, it's a hard thing to consistently do. It's easier to control it, I guess, control it years down the road as it's going. Because when you go into it, you're taking out old vendors, you're putting in your vendors. This is the whole benefit of having someone that's in the area. So we bought a property a few months into COVID 2020, and literally they're paying three times. It was like 2x or 3x on trash that we would be paying. Now they never canceled their contracts, so we had to hold them for like another 3 months or something like this until we could cancel. However, it was one thing that could be done once. I can't do that every year, right? I can't do that every time that a new renewal comes up on the contract. So that's one time thing that's done, and these are great. The thing though is that I think there's also a fine line between you want to have the property, you want to run it as efficiently as possible, but you don't want to risk it going into any type of disrepair.
That's right.
And I think it's difficult with new people that are going and I see like really drastic cuts. And you're like, well, a little worried there because we're supposed to be putting more money into the property. That's the whole point of the value add. We're adding money into the property correctly. Yes, we're not going to be paying someone, we bought one property and had one of the managers was getting paid 15%, right? So it's insane. It was like his brother, the guy's brother, a father, ex-son-in-law or something that was managing the
Mhm.
property. And it was like, he's like, oh, I can stay on for you. Like, no, it's okay. Thanks. You know what I mean? But like, because we had a manager with hundreds of units that we had there, they were paying like 3.5%. So it's done one time and it's
Mhm.
great. But the thing that was that you want to make sure that if I didn't know about that new management company, I'd still be a little wary about you have to bring someone on. You want to make sure that's staying at the same level, but not even I want them to be even spending more attention in it because there's gonna be a lot of time they're gonna be spending at the property going through a renovation. You know what I mean? We're gonna be making changes to the property. It's not gonna be like a stabilized property where you might see it and it's just kind of generating cash flow and we're just renting units, painting, cleaning, renting units. We're not doing any major renovations. That's a different type of management style that we need to have with our manager. But I think one of the important things was that if focusing more on increasing the income, I think is the most important part of it. Decreasing is important initially when you're getting into it, but knowing that that's not a long-term business strategy, it's really knowing that it's going to cost more money to get the property to where we want. And it's going to be very important for us to focus on generating income and how we can do that, where we can also maintain a high occupancy in the property. And I think that's another thing too, where you can say decreasing expenses is simply in different ways of going further is just saying, hey, we keep our units, they're usually vacant for 6 weeks, right? From the
Mhm.
time someone moves out to the time we renovate to the time we rent it. Well, can we cut this to 3 weeks? You know what I mean? Or at least 4 weeks, whatever it might be. And that's something where in operations, now we're saving, getting another 2 weeks of income coming in. Because not only do we pay for all these renovations, but we also have downtime. So stuff like that in the whole kind of procedural part of running the business is important. But I think just on a way of just decreasing expenses or increasing them, and obviously put stuff out to all your contracts out to bid, knowing that a lot of those cuts are going to happen initially and they're just not going to be something that's going to go to your bottom line every year.
All right. And any particular strategies to mitigate the risk in the real estate investment that you?
So when I talk to new investors, there's really three things, and you can use this kind of at every level of property, maybe in different asset classes outside of multifamily as well as too. But it's really um, an older real estate investor told me one time, and it was, it's a 10-year kind of rule of real estate where if you buy real estate, if you can hold on for 10 years, it's going to go up in value. It's very
Mhm.
rare that you're going to have a property that's going to go down in value in 10 years. So the whole thing is prepping if you want to minimize your risk as much as possible, going one step further with what he's saying is that prepare to hold the property for 10 years. And my sense is that I tell people, longer term debt, and obviously for you're buying 1 to 4 unit properties, you can get that 30-year term debt, but there's also There's also banks out there on commercial properties that will give you longer term debt than the typical 5 to 10 years, but really going 10-year plus on a debt term, having a reserve fund, as we talked about, buying properties that are already cash flowing and, buying in good areas. That was one thing that I learned the hard way. And when you buy in better areas, if you're an investor and you've gone into a better area and you already own rental property in an area that's maybe not as great compared to where you just bought in, you will see it be night and day between the tenants that are attracted,
Yeah.
the time frame that they stay in your property, the minimal hassle compared to another property. It's difficult if you're like, oh, I'm just buying in this area. Well, that's great, but if you got out of it, you're going to be paying a little bit more. However,
Yeah.
you're going to have a much better experience for yourself as an investor. It's going to be easier to get property manager. Everything's easier, right? You're not
Yeah.
going to have like
Less
contractors. Yeah,
maintenance, everything. Yeah.
it's less headaches altogether.
Yeah.
And I think just kind of putting those four things together, long-term debt, cash flowing properties, reserves, and buying better areas, if you put those together and have a plan of buying a property and saying, I'm going to keep it for 10 years, and here's a plan of how I'm going to do it, it's very, I think you've really minimized any chances of losing money on that deal.
All right. And now let's take a step back about, raising capital, right? Investors relationship. Uh, when you started investing, or when you got your first active deal under the belt, how difficult was it for you to raise the money? What are the obstacles or that you faced while raising the money for that first deal?
So when we were putting together our first deal, and I had met my partners about a year before, and they were looking for deals, and we keep in contact, and they found one. I already had investors that were already lined up to invest, and
Yeah.
the problem wasn't on the investors I brought, and this is also, it's my fault as well, but I had other my other partners, we all said, okay, we're going to raise this much money. We're raising that 1.8 million. I believe it was 1.8, 1.9. So, hey, this is what I'm going to bring. This is what I kind of have all set. This is what this person has and all this kind of stuff. And this is kind of what we're raising to support people.
Mhm.
What I didn't know was that my investors were very solid. They were ready to write those checks when required. However, other people's investors weren't
Yeah.
as solid. And that added to a lot more stress in the deal that was required because if I had just asked beforehand, so who are these investors, and not getting like names and stuff like this, but like, is it one investor? Say you're bringing $400,000. Is it 8 different investors? Do you have any backup investors that are waiting there? If you
Mhm.
have these things, this is something that's a very important conversations to have because what happened was that getting close to closing, a couple of their larger investors, just kind of fizzled out, which happens, you know what I mean, a lot. So it's something where it's much kind of it's a much different thing if they said that they had 10 different investors that were going to bring $50,000 a piece in
Mhm.
and say we only needed 400,000 from them or whatever it might be. Then it's a different story, but it's a different thing when you're saying that hey, I have this 400,000, let's just say, I don't know if that was the exact number, I've got two investors. That makes me a little bit more worried. So what
Yes.
we had to
Yeah.
do, myself and one of the other partners, we literally had to kind of really dig in over like a week and kind of reach out to everyone we knew. And those are very awkward, difficult contacts and calls and emails because they can spell it on you. You know what I mean?
Yeah.
So
Yeah.
it's like I was like,
Especially when you are asking for, these kind of investments for the first time, right? Yeah.
yeah, and it's easier for my investors because they had known that I'd been involved. I think I was already involved in multifamily as an owner of 13 years, but for the other people that were involved with it, it was like 1 or 2 years, right? They didn't have any experience with it, and people that invested with me weren't family, but they were like past business acquaintances, right?
Mhm.
People I'd worked with before in other industries, mainly the payment processing industry, and they wanted to invest in the real estate. So that was a much easier conversation. They were just kind of like, okay, just tell me where to invest. You know what I mean? Tell me what to do. Tell me this, and that's kind of how it worked. It was kind of difficult because I had one of my investors that was, his first time investing in something like this, and he was going to write me. He was going to give me. He gave me one amount, and then he called me back. He's like, I'm going to give you, double that. You know what I mean? And I remember I was walking with my now wife, and I was like, you know what? I'm not going to accept that money from him. And I didn't tell my partners this, but I'm like, he doesn't understand 100% what's going on. And, we're just going to keep it at like what we initially talked about. And, he really applauded that, because I think that was just something that, hey, like, just, put in what you said before, you do that, and it's going to work out well. And it did, you know what I mean? I think we did like 1.78 1.76 or something X on that deal. So it was a very good deal. But the thing
Mhm.
though is that obviously we had a market behind us. But we went through COVID too, where we had to pause distributions for time. I mean, it was a difficult time, especially when you're buying C-class properties, which were kind of in that area that were a little bit more beat up during COVID than maybe if we had purchased better properties.
Did you have any foreign investors or everyone was local?
One of my investors, my first investor in that deal was foreign. He was a expat, living in Europe, and I had one other one as well that was foreign. I think he was living in Central South America at that time. So it was, yeah, it was
Uh,
they
so
weren't yeah.
what's the strategy for them to invest here in US? Just if there is any out of country investor.
Yeah, so great question. Usually, what happens is, first of all, if they're expats, it makes it much easier because they probably already have. I mean, obviously, they have a social security number and stuff like that,
Hmm.
so we can invest right through their own name.
Hmm.
And it doesn't matter what your home address is at the time, or if you have a U.S. address and a PO box or whatever like that, you can use that. You know what I mean? UPS store, it's not a problem. The thing that happens is where we have to put some extra steps in is where it is uh, a a foreign investor that doesn't have any really connection to the United States in the sense it doesn't have an ITIN number, doesn't have a entity or anything like this. Now, what we'll do is when we're talking to new investors that are foreign, usually what happens is that we'll give them an overview, which I'll go through in a second here, of what they have to do, and then we'll point them in directions of a few different professionals that can assist them, CPAs that work with people in other countries, foreign investors, and attorneys as well. And then they can kind of make the decision on who they want to work with. And I think that's very important. The second part with that is that usually what's happening is they're going to come in. We suggest, they're going to work through a professional. Don't do any of this yourself. It also moves the process faster through, but
Hmm.
they're going to get an ITIN number to sign up for that. Then what happens when they have that ITIN number, they're able to open up a corporation here in the United States, usually an LLC. And then what happens is they can open up a bank account. And once they have those kind of three things set up, now we can use that of what they're going to invest into the property. They can get their distributions out through it, and then it's just it's after that it's pretty straightforward, like it would be for anybody else as an investor. The problem is that sometimes they don't have that set up. And the last thing too, I think just one of the important things, if anybody's listening that's interested in working with foreign investors, definitely point them in the right direction to people that are working with foreign investors. And have them be the ones that really walk them through. Don't have yourself walking them through. And I think the other thing too is that don't accept money from. Make sure that your attorney and your title company know that you're not accepting foreign money directly. You know what I mean?
Hmm.
Um, I don't want to get involved with anything like that. I mean, if I'm speaking to someone and, they sign up a call with me and they're talking and 3 months later they want to invest with me, you have to make it known from the beginning that it has to come from, not, not just a U.S. entity, or it could come from themselves if they had a personal bank account in the United States, but it has to come from a U.S. institution, right? Banking
Hmm.
institution. And the reason for that is because of the KYC, know your customer.
Yeah. Yeah.
And if someone listening to the show, or you, Ted, I mean, something like this. I mean, we don't have the resources of, say, Bank of America, right, or another large, U.S. banking situation where they're going to be able to run people through different checks and different lists, and see if someone's on any type of list that they shouldn't be on. And
Hmm.
if they're taking it from there, it's a pretty safe bet knowing that we are getting, let's say, legal clean money and
Yeah.
that it won't come back to bother us in the future. The other thing too is one last thing is that I've had investors take money from international investors before and no one was doing anything incorrectly. but just that one of the entities that was investing from, where they were sending the money from, came up on a list, right? Not the same entity, but just one name in the entity. Got mixed up with a name from apparently some drug cartel or something like this, and the money was
Mhm.
held for like months, right?
Mhm.
So imagine, going back to your investor and saying that, hey, just I don't have your money, you don't have your money, we can't buy the deal. Just letting you know this. I mean, that's a worse conversation than going to
Yeah.
someone trying to raise money. So it's just like you have all these things lined up beforehand so that that everything's going to fall into place and you're not going to have any kind of awkward conversations with people. If you just tell everybody up front, it has to happen like that. I think it's the best way of doing it.
And you don't want to deal with all the tax liabilities, right? When you're paying directly to any foreign entities. That's the
Yep.
other thing. So,
Yeah. Yep. That's going to be something that as the syndicator is going to do, that's going to be one thing that they're going to be doing it, but it's really going to be the CPA. So that's the last part of it, making sure your CPA, if you're the general partner on a deal, who's ever running your syndication paperwork and doing K1s and all that kind of stuff, make sure they're aware of that as well. So they can their withholding during any type of payouts to any of the investors that are foreign. And uh, this is similar to if you're selling a house or something like this to a foreign person, sometimes it can be you get into like the same kind of situation. So these are things that you just have to double check on, no matter what type of real estate kind of investment or business partnership you're doing with a foreign investor. Always check with your CPA with all this stuff. But really, getting them set up is doing that, and then just letting them know that there's going to be that withholding, which they're going to have to file taxes at the end of the year. Once they get their K1 to get that money back.
that's true. All right. So now, you know, with as you know, the Fed is cutting the interest rates, right? The Fed rates, I would say, but the mortgage rates are still up high. It's not making uh, any. There's no drastic change. It's not coming down as it needs to. So, given that situation, where do you think in next couple of years, you see the market moving?
Um, um, I'll speak to when we actively invest, we are strictly multifamily investors. It's something that I know inside and out. When I passively invest, it's mainly in multifamily as well. So it's an asset class that I feel that I know a lot about. And, we saw interest rates come down about 1%, which gave a little bit of breathing room to people with short-term debt, right? Running off a SOFR and stuff like
Yeah.
this, or LIBOR, whatever was on before when you got your debt. And the, I think what we're seeing in multifamily is we've seen so many units come on the market in 2024 and 2025. I think it's going to be coming down 12 to 15%, and that's going to continue into 2026, 2027. So it's really, you've got that 3-year lag between when construction starts to when construction ends. And
Yeah.
obviously 2022, the end of 2022 is much different than the beginning of 2022 if that's when you got your debt, right? So it's much more difficult. And when those deliveries come, there's going to be less of them because there's less starts 3 years before. And I think that's what we're seeing now is we're going to start to see there's going to be a little bit more easing on rents not going up, and we're going to have rent increases starting in 2025. 2026, not major ones, but I think it's going to get closer to normal.
Yeah.
Everything got thrown out of shape in like 2021 and stuff like this, and it's been coming back over the last couple of years, and I think it's going to restart to be more normal. With interest rates, I don't see them really changing much. So I think what you're paying now, we're refinancing a property right now that we have on short-term debt that I think we're paying like actually it's like 8.16%. I think we have a cap on that, so it's like 7.86 or something, and we're going to be bringing it down to low sixes, right? About 180 basis points above the 10-year. And with that being said, that's going to be something that if we rate lock today, something like this. So if that's I think that's something that's going to continue. You know what I mean? I don't think we see much difference in that, changes in that. I think they have to be a little careful now because we don't want to, reignite inflation, which we know
Inflation.
is
Yeah.
very difficult to deal with, and it really, it really dampers the economy there, and it makes it much harder on everybody. But I think that's where interest rates are going to stay, and I think we're going to start seeing some rent increases in multifamily, and I think we're going to start seeing, as we see rent increases come back around and less deliveries, at those kind of like start kind of dwindling off little by little over the next 2 or 3 years, then I think we're going to start seeing more properties changing hands as sellers that have a number in mind, whether they just have it in mind or whether they need to get that number. You know what I mean? It's maybe because of their debt on the property. Those are going to start coming. Those numbers are going to start coming closer from what people want to pay to what people actually want to sell for. And I think that's going to, again, reignite it. And I think that's the big difference problem that we have now with the lack of deals changing hands, is that there's just that huge spread between.
Yeah. Yeah, that's what we have seen also. Everything is locked up right now. That's not much movement there. Yeah, there are a few deals here and there going on, of course, but there's not much movement as it used to be before.
Yeah. Another thing too is important with personal houses. I was just reading something last night, which was saying that 17% of people now have rates over, people with mortgages have it over 6%, 6% or more, and that's something that is like double what it was a couple of years before, maybe even triple. So we're starting to see people. What that means is that properties are changing hands more on the residential side, and that might be something that in 2 or 3 years that number might be twice as much, right?
Yeah.
And that's going to start as people become more comfortable or just knowing that interest rates aren't coming down to what I had before. I just got to bite the bullet. You know what I mean?
Yes.
And I think that's something that realization's already started in residential.
All right. Hey, Charles, loving this conversation, but want to be mindful of your time also. So would like to switch to the final round of questions. Are you ready?
Sure.
All right. Okay. So the first one, which is the one book that had a most impact on your life or on your business?
As a real estate investor, I would say Art of the Deal by Donald Trump. I read that in 1998, and that definitely gave me a whole new perspective on investing in real estate.
All right. What are your main source of information to learn and grow?
Main sources, I put together our newsletter, and I don't have one exact one, but I look through about 30 or 40 different websites on the economy and on real estate every week when we put together our newsletter. And I think that's one thing that when I come back from that, it's what I pull from that newsletter is really all the information that I use throughout my whole investing career. So not one source in particular, but I think reviewing, there's so many different good sources out there, and kind of pulling from all of them. I think if you put together some websites that you check regularly, and just pulling information depending and being as most mindful in your industry as possible, your asset class in real estate.
All right. What is the best business or investment advice you like to give to our listeners?
I think from real estate perspective, something I shared earlier, I would say the 10-year law really of real estate investing.
Yeah.
I think that was an important thing because it changes your mindset from being stuck in, hey, everybody's making money in 2 3 years, flipping properties, tripling their money, all this crazy stuff, and knowing that that's not normal. The 10-year kind of law of real estate really holds. It's really in any asset class. You buy index funds, you know what I mean? 10 years, you don't do it in 1 year, you're probably going to do well.
Yeah. All right. And which is the one habit or routine that had been crucial to your success?
I think a couple of years back, I changed. I wanted to read more books, and it was something that just kind of doing it in bite size of like 10 pages a day, and able to read like 15 books a year or something. It was crazy, I think, last year. So I've never read that many in years, and it was just something that just, if you just have something little by little, you do it, and you're kind of amazed afterwards of what you've achieved. So 10 pages a day.
Right. Sounds great, man. Love it. All right. Final question. How can Decoding Cashflow listeners get in touch with you?
Thank you so much for having me on today. You can reach me. My company is Harborside Partners. So if you go to harborsidepartners.com, and on harborsidepartners.com, a lot of information there. I have a podcast. I have a YouTube channel. I do 2 episodes a week there. And there's a lot of information. And then also, if you're interested in passively investing, you can sign up for a call with one of my partners. Most likely, I do most of those calls. And then also, if you're interested in actively investing, we have tons of information there as well.
All right. Sounds great, man. All right, Charles, it was a pleasure having you here, and we'll stay in touch.
Thank you so much.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.